Excellent. So again, guys, a very, very special guest with tonight, Mr. Spencer Hilligos, based out of the West Coast. And Spencer has been somebody that I've definitely looked up to in the industry. We've had the fortunate pleasure of connecting about a year ago, right, Spencer? And
That's right.
very, very great story. And, Spencer found real estate as a way to build a passive income portfolio, which eventually led to him leading his very high earning IT job and becoming a full-time real estate investor, and has since built a very large passive investing portfolio of over, I think, valued over $500 million, right, Spencer? And has also found himself partnering with other co-sponsors and operators on the GP side as well. And he's very well connected in the industry. So I think we're going to learn a lot from Spencer tonight. And Spencer, thank you so much for being here, man. Welcome.
Yeah, absolutely. Honored to be here, guys. So thank you so much. I think, and by the way, Cody, absolutely a friend. So yeah, no need to qualify. So I think in terms of just telling my story a little bit, I think I'm a visual guy. So hopefully you guys aren't going to be weirded out by the fact that I didn't used to have slides for this particular story. And it's not like some epic origin story. It's not like a superhero thing. It's just the quickest way that I could effectively convey how I stumbled through the steps that I stumbled through to get to the point that I'm at now, knowing that I certainly don't know everything. In fact, the more that you learn, the more that you realize that you don't know. And I think that particularly in an older industry like real estate that is rapidly evolving still, that is just so critical to remember, right? Is that there's not a single day that I come in and I'm like, I'm going to know every answer to every problem that I encounter today, which is both exciting, terrifying equally. But if that kind of dynamic, excites you, then that's a good sign. So is it okay if I share my screen here and just put some slides on the screen here, Cody?
Yeah, you're all good, Spencer. Go ahead.
All right, rock and roll. Let me do this here. You guys could tell me if I am able to click the button successfully. And I do want to mention as well, some of these slides I put together specifically for actually a presentation I was very fortunate to do for the Apple, as in Apple, the tech company's real estate investing club recently, just a couple weeks ago. So not going to rehash the whole deck, just going to use a couple of specific slides in here because I think it's relevant. I think it's relevant also just because you guys will be able to see the journey briefly, and also just kind of how I think about like passive investing and the most important things to put weight on. The reason you're seeing a big disclosure on your screen right now is not because I'm trying to put you to sleep, particularly those of you who are on East Coast and Central Time, is because I'm actually also a registered representative with FINRA and the SEC. And so, none of this is advisory, none of this is tax advice, none of this is financial advice. None of this is in reference to a certain deal. And these are the types of disclaimers that you get to do if you are working under the capacity that I am, both as a co-GP and occasionally also a placement agent. So background, I used to be in tech for about 13 years and in tech companies, starting big, going small. Eventually stumbled my way into LendingHome, which was now the biggest fix and flip lender for single family homes in the country. Built the origination groups for that business, and live in a little island city called Alameda in California, with my two boys and my co-founder, who is also my wife. That's Jennifer right there, and our kids. I always have to give a shout out. I'm born and raised in Redwood City with the most boring sign you've ever seen, climate best by government tests, moderate weather there. Lived in Denver for about 10 years, or Boulder and Denver combined between the two. Love Colorado. It's like a second home to me. We do a lot of deals in Colorado these days too. That's Alameda, in case you want to see what our little city looks like. I am the CEO of Madison Investing. I have gotten feedback recently that I don't talk enough about our own company when I'm connecting with folks. So I'm just doing this not to plug us, but just to say, this is what we do. This is my company. My co-founder is my wife. We can move on. We actually partner strategically with a limited set of asset managers across the country. If it's a single asset deal, we take our time to get to know these partners. What we do is I invest my own money with them, see how that goes as an LP over time. We put them through a vetting process. And then as deals come through, we build good relationships with them and deepen that relationship. And we say, hey, we'd love to be able to work with you in a co-GP capacity. Sometimes that means more. Sometimes that means just, bring equity capital raising, and also investor relations for the duration of that hold period. And now we're focusing a bit more on funds. And so I think this is a good year for fund structures, which is very different than I used to feel, is because, in 2021, if you ask an economist, like, you can go poll 10 different economists and you're going to get 10 different answers as to what's about to come. So it's volatility is in the air a little bit for me midterm, not short term. I think short term, we're all looking rosy. I'm not an economist though, so don't quote me on that. Journey, here's my journey. I like click through decks. So this is what happened. I grew up in a real estate business. My dad was a broker for 30 years. That tiny picture you can't see, there's a bigger version of it. That's me. I'm not the guy, I'm the kid there. So I grew up in that business. Eventually, as a teenager, I was doing open houses. I was kind of a gopher for his business in a lot of ways. And then we went through some really like interesting, tough stuff on the way to becoming a tech professional. It's relevant for this group because it kind of informs how I approach stuff and think about stuff, and as a passive investor as well. My dad's like, we went through a bunch of tough family times, like 10 years of basic, like, family challenge. I lost a brother to cancer, parents got divorced, a bunch of stuff happened. My dad's business imploded to a degree, and we downshifted our lifestyle a lot. I'm not going to make it sound like we were despondent, but it was a big shift. And I watched what happened when active income, a single stream of active income, immediately went away for a household. And as a dad now with my own kids, I think about that a lot. And even when I was still working full time in the tech industry, so I spent, better part of 13 years pretty much in fintech, financial tech, like big tech companies. There's me looking stressed out while I was trying to build my real estate business on nights and weekends while also doing the tech job at the same time. There's a close-up shot so you could see how stressed out that I looked. That was like burning the midnight oil. I've literally put this in here just so you guys can see, like, wow, that guy looks like he's thinking about 20 different things.
That looks like when you were like 18, Spencer.
I mean, it's been a long few years, Cody. But thank you. I appreciate that. That was like, gosh, that was probably like maybe 2018, 2019 or something like that. So as we were talking about fitness beforehand, I got to get back to it, man. I think in terms of how did the investing stuff start? I was exposed to real estate at a young age. I did not necessarily see my dad investing in it that way. So I got the side of the transactional brokerage stuff, but I didn't get the memo on investing in real assets. I had a traditional setup, 401ks, index funds, all that stuff. Didn't really see a light at the end of the tunnel financially, except for working another 20 years, like 80 to 100 hours a week in tech companies and leadership roles. And that led me to start investing ultimately in real estate, because I saw at LendingHome how much people were making on these flip deals. And I was like, I don't want to be a flipper. I could barely swing a hammer. I rely on YouTube to fix the most basic, embarrassing stuff around my house. I know I'm good at certain things. I know I'm good at operations, and so let's go start investing. Spent a whole summer looking around for a rental, bought a duplex. We still own that duplex. It's appreciated. It's in California. Cash flow is $200 a month, which ain't too bad until I tell you that it costs $430,000. And so that sounds great. And then you're like, wait a sec, that guy literally put in over $100,000 cash and to get a duplex that cash flow is $200 a month. But cash flow investing, cash flow goal setting was not quite embedded here yet. And I think depending on your goals, that's the kind of stuff that really makes a big difference when you're trying to figure out your own path and your own strategy. And so we went out of state eventually. We could realize that we can get more from our dollar by looking elsewhere into other markets beyond the Bay Area. Built up a modest portfolio of turnkeys. I was mentioning that earlier on one of the breakout rooms. We actually just sold those at the beginning of the year. Not because they weren't cash flowing, but because they were paying in our butt. So they were just too much work. And I'm being picky about that. I mean, we had to manage the manager. These are turnkey properties, but we still were on a phone call every month with those guys. Eventually found this whole world of syndications and funds, started to put our money into them as LPs, as limited partners, and then realized like, oh, well, this strategy matches our goals in our lifestyle currently. Maybe there's a time in the future where our kids are older. I have a 7-year-old and a 3-year-old, so very hands-on right now. But there might be a time where we get more hands-on with the projects in real estate endeavors. That's not now. And so we started investing in syndications, and eventually I was like, you know what, I want to go and get more active. And so realized from a mentor of mine, like, hey, you can go do this. You know, you kind of got the entrepreneurial spirit. Why don't you go out and start partnering some folks? And we did some co-GP work, and have now done that on over 22 deals over the course of years, large apartment communities, primarily 150 units and up. And now also doing some storage, which is why I see a picture of storage. Believe it or not, that one is in Houston. That's a real property in Houston. We closed back in November with our partners. And so that is my nerdy click through for the background on me. You know, I'm a huge Texas fan. I know we're talking about a Texas meetup here, but I think in terms of real estate investing, there's just so much goodness. And it was already good from my perspective before the pandemic. I think it's almost like in some ways, you know, some of the data that you might see, depending on on where you're pulling it from and who you talk to, it actually tells an even more positive story about Texas real estate now. So big fan of that. Wasn't necessarily going to fly through a whirlwind refresher on syndications and stuff, Cody, but at least just wanted to give that background. There is some stuff that would be fun to go through if you guys wanted to. We can go through just like how I basically think about vetting passive investments, but you tell me, Cody, like how much, how little?
Yeah, no, I think that would be a perfect start, Spencer. If you wouldn't mind kind of talking about how can people get into their first passive investment and what should they look out for?
Cool. Yeah, I appreciate the guidance. Just want to make sure I don't put people to sleep. I know it's the end of the day for some folks. So, you know, I think there's a few topics and themes that you're going to hear me hit on here. And please, like any other piece of advice or guidance that is out there, guys, is like, think about how it applies to you. You know, there's so many asset classes. There's so many strategies. And frankly, I think the one of the only pieces of advice I'm authorized to give here would just be great investing is not about or, it's about and, you know, and because you're going to go through phases of your life, phases of your business, phases of your investing, phases of everything, really. I mean, life is lived in chapters. And so it's really, you have to focus on something long enough to understand it. I have found, like, to really dig into it and become competent in it to effectively invest in it. That's kind of my feeling. But ultimately, it's about making sure that you really have a framework to make good decisions. And so I did not come up with this stuff on the screen right now. A really smart person who I'm not even sure who originally came up with this framework, but it's prolific. You see it all over the place. If you're looking at a syndication deal, meaning it could be a range of sizes, you know, and so this doesn't just apply to like 150 unit up apartment buildings. This can apply, you know, across the board. It could apply down to smaller properties. I mean, like, you know, 50 units to 100 units. It can go even higher if you wanted it to, but you can vet the sponsor, the market, and the deal. And I want to demystify some of the terminology because that is just straight up jargon. Drove me crazy when I was trying to figure this stuff out. As a guy who did a lot of work on professional development in the corporate world, words matter. And so I felt like, you know, syndication terminology can be pretty distancing for some folks, but this is really what we're talking about. If you're evaluating a deal, you got to think about who's the sponsor, where's the deal, and then all the other stuff. And there's a lot of stuff in that stuff, but everyone goes straight to number 3 and they completely miss the point. This is the most important thing by far. If you're talking about passive investing, you could basically stop the rest of the presentation and still get most of the takeaway right now on the slide. There's a lot more slides. We're not going to go through all of them, but this is basically it, is who's the sponsor, right? And these are all just different terms that you'll hear people use, whether it's on a webinar, whether it's on a pitch, whether it's in an awesome meetup, whether it's in a one-on-one call you have with someone. Just try to see through all that and just understand, who are they actually talking about? Where? Man, market terms are just really confusing sometimes when you first get into it, right? Because there's different altitudes. The most confusing thing I would say that is not helpful is national news media makes it sound like the real estate market is this big object that just moves, and when it's up, it's up, it's down, it's down. It couldn't be further from the truth, right? I mean, there's general themes. This is a hyper local business. It's like all the way down to the neighborhood. And so you can have like block to block differences in an individual submarket. It all depends. And so just important distinctions and learnings that I feel like I wish that someone had told me earlier. Like when I say, hey, we focus on these markets, that doesn't mean I like Texas and then we stop there. As the dumb Californian that flew out to Texas for my original kind of due diligence trips in this business years ago, I fly into Dallas and I'm like, oh, cool, I'm in Dallas. And then I think the Uber driver's like, you know, Dallas has like 170 individual cities in it. And I'm like, wow, Uber driver just schooled me. So you really got to like take those nuggets and run with them and think about the fact that that's even like individual cities, let alone the neighborhoods, let alone, you get the idea. Here's some terminology that I think I don't have a mandate necessarily, or I don't have ownership of all of these terms, and I don't coin them. I just borrow them and try to apply them to the best of my ability for a situation. Property type matters, property conditions, strategies, different business plans that are used in these passive investments. Like if you're looking at an apartment deal and it says it's a value add, there's different types. There's different types of value add. And so at first you come in, you're just like, well, value add, what does that mean? If it's a C-class property, okay, cool. Yeah, so they're probably going to force some appreciation with some value add, meaning renovations, improved property management, lower expenses, working more efficiently, all that stuff. Right now, a couple hot topics that would come up specifically under that almost a final bullet there, like conversions. A lot of people talking about conversions. They're like, hey, look at that motel that it's completely, or that hotel that it's not being used whatsoever after the pandemic. Let me go turn it into a multifamily, right? Like this is a dynamic, interesting business. And I don't claim to be an expert on any one of those individual strategies. I just know, hey, there are people out there actually executing these things, and they absolutely are experts. And it's your job as a passive investor to figure out if they are. And so that's why we do what we do at Madison Investing. I think this isn't a pitch on the company, just to explain. We vet first and foremost, like, who do we work with? And this isn't some hardcore binary process where overnight I'm like, yes, no, this is deeply a relationship business. It's a very small business. And I think a lot of people within it oftentimes will lose sight of the fact that, like, you got to do things with, I'm going to be a little soapboxy here. Sorry, Cody, but like do things with integrity, do what you say you're going to do, speak positively of those that are not in the room. All of these things that matter deeply to me. All that said, you can still have your opinions, and you can still have your frameworks and your business decisions that you have to make. And so these are the kind of the 5 categories at a high level. I have this in a spreadsheet, believe it or not, broken out in our own business. It's like an internal document, so I don't have like a shareable, cool branded version of that to share publicly necessarily yet. Maybe we will in the future. But we look at the track record of the sponsor, the approach that they use, and approach is going to mean a bunch of different things. Who's in the team? Who's in the team? How do they get along? That might sound really corny, man. 5-year holds, 7-year holds. That's. I mean, people use the example of it being a marriage. Not that far off. Like, as an LP, you are in this deal for a good period of years, right? Longer than college or undergrad. So you got to figure out in the GP team too, are these folks getting along? Are they scoping their roles and responsibilities in thoughtful ways, or are they, everybody does a little bit of everything? Nothing wrong with that. As long as everyone is on the same page about that, that's good. Communication. How do people communicate? How does the sponsor communicate with their passive investors? And just in general, I mean, one of the most interesting things that you can ever catch on an email thread that speaks volumes about a person's character is, if you're on an email thread with a sponsor and they have their admin on there, are they speaking to their admin with respect? I'm sorry, but that matters. Like, that matters a lot. If they're disrespectful to their staff, I don't want to work with them. So, and that's a good segue into values, which is just, I mean, this is literally, like, real estate's a fascinating business because we all have a relationship with it on some level. I've lived in apartments. You live in an apartment now, perhaps, or you live in a home. I'm in a home right now. Like, we all have a relationship with it at some point. So it matters to establish, at least from my perspective, if you're working with a sponsor, like, one of my favorite questions would be, before we decide to move forward and co-sponsor or co-GP with someone, like, what is your philosophy on tenant relationships, on tenant management? And it's just an open-ended question. I just want to know that they have one. I don't want to know that they care about the people that are living in the units. Now, they're not like a rent increase and that's it. And so, this isn't going to be an ethics soapbox. It really is not. It's just about putting some thoughtfulness around who you work with and how. Each of these has some sub bullets. I promise I won't read each of these in a row. I know we have limited time, but this is the stuff under track record that I think distinctly stands out from our broader list. Past projects, how have they done? If they don't have past projects, I'm very open to new sponsors and working with new sponsors, of course. But I do want to know, like, failure response is one I'm going to highlight here. Everyone has been through something brutally challenging in their professional career if they've had at least some experience in anything. And I just want to know, what is their response when they go through that? If like, are they able to speak to a very specific time when they're like, man, I got figuratively punched in the gut, and this is how I dug out of it, and this is what I learned from it. And if you're in the corporate world currently and you have ever done behavioral interviewing, you're going to notice a theme there. It's just borrowing heavily from that same kind of construct of like, tell me about something you've done. Not a what would you do if, because we're assuming the past behavior is going to help inform the future. But got to make sure people have skin in the game. They're investing their own funds into it as an asset manager. Ideally, they have some exits, meaning if I'm a passive investor and I put in 50K, 100K into a deal, how has that gone? And so you're trying to figure out, like, has that gone full cycle if someone has actually bought a building, improved the building, sold the building. And if they haven't, not the end of the world. You're just trying to figure out where they're at. Ultimately, on approach, the only thing I'll say on this slide would be you're trying to find teams that have a repeatable business process, like a playbook. I used to that term used to really bug me as a side note, because the playbook is like, could mean 1,000 different things. But a repeatable business process means if someone has done something one time, like if you bought an apartment building, if you've done a flip, if you've done 2 flips, if you've done 3 flips, just someone has developed processes along the way. They've also skinned their knees on a few things that allow them to do a good process, to build a good process out of that. So it's important. Talked a little bit about this briefly, but background checks are key. Yes. What's even, I would argue, more important than that is taking that extra step as you're evaluating sponsors and just like sitting there and thinking about, okay, some places you'll hear like multifamily sponsors, storage sponsors, senior housing sponsors, whatever the asset class, like they'll say they're vertically integrated. And like, what does that really mean? So sorry if this is like way, table stakes basic stuff for some of the audience here who's like, dude, I get it. You like stop telling me about this stuff. I think it's important just to like click it down one layer further as an LP and just like understand, cool, is the sponsor using a third-party management company? That's fine, very common, like absolutely fine. But like, just know that. Just like, take the time to understand the mechanics and like read the PPM, like understand who is involved in doing what. And so vertically integrated just means they do all this in-house or with their affiliated entities, or are they hiring a third party? How much are they paying that third party? How competent is that third party? How hands-on is that third party? All of these things play in and are very important. And over a long enough time horizon, sometimes we talk to LPs or limited partners, passive investors of like 20 years plus, who are way more badass than I am. And they will basically just say the number one thing that matters to them is not any of the stuff I just talked about. It's how does that team communicate? And it's because when stuff goes well, it's easy to communicate. When stuff goes poorly, it should be even faster. It should be like immediate, like they want to hear when stuff goes poorly, because it's not the end of the world to them if there's a hiccup. Like experienced limited partners and investors, they've seen enough to know stuff doesn't go perfectly. So they just want you to tell them up front. They want to be spoken to like adults. And so that's kind of the nugget I would just say is like, and of course, if someone does take, if you ask for a pro forma Excel sheet and they provide it to you the same day, that's awesome. If they say, yeah, I'll get that right back to you and it takes 7 days to get it, they just built it. So, these are the things I would keep an eye on as you're trying to kind of parse through as an LP, as like a limited partner, what to think about. I already soapboxed at you guys enough on the value stuff, but I think that's about it with my nerdy slides. Sorry for going so long with you, Cody.
No, that's perfect, Spencer. And man, you brought up so many great points here, and I think it's going to lead into a lot of great questions. So I encourage anybody, as we continue to have this dialogue, if anybody has any questions, feel free to come on screen, drop in the chat box. We'll make sure to get that over to Spencer. But Spencer, one question I would start off by asking is, for you, what is the most important aspect of the vetting process? Like, which component is more important to you? Is it the sponsor? Is it the deal? Is it the market? Like, when you're looking at an opportunity, what component is the most important to you?
Sponsor, but by a large margin. I think what's interesting, and I'd say particularly challenging for those of us that like spreadsheets, is that the numbers are so tangible. and the challenge is that they can also be like, is it critical to vet the numbers in the deal? Yes, clearly. If I had to put a percentage to it, a big disclaimer, this is not a quantitative firm percentage, not mathematically backed. I'm using it as just an assumption for you guys. 70 to 80% of the vetting as a passive investor should be weighted on the sponsor, period. Like, I don't want to overemphasize that, or underemphasize that rather. I think it's critical to make sure that you've taken the time to get to know them. And if they're super experienced, it's a little bit easier to tell that because you can see, exits. It's okay if sponsors don't have exits, in my opinion, because right now, some of the most amazing, hardworking, capable sponsors out there that are hustling harder than people that have 30 exits in their portfolio, I will trust more because I know that they are dedicated fully and focused on doing that project. And that is awesome. And I want people to take that away as a motivational point, as absolutely, because you better believe some people that are sitting on robust, they've already fought their battle, basically. If they're late in their life, I would rather have the hungry person, frankly, oftentimes. And so there's no silver bullet here is kind of the key takeaway, is like, you have to take your time, and go slow to go fast. As corny and contrived as that sounds, it's like a phrase that I did not come up with. I could borrow that from the tech world. Like, when you're getting to know people, just don't jump into something if you feel like you don't have a good sense of it yet. But put the weight on the sponsor.
Yeah, that's great feedback. And, I'm glad you alluded to that, Spencer, because I think a lot of times when we talk about vetting the sponsor, we do talk about looking at that track record, that experience, right? And unfortunately, a lot of time the emphasis is on, well, make sure you have somebody that's been through, maybe another downturn, maybe they've had a certain amount of years of experience, maybe it's a certain amount of units. And unfortunately, what happens is the new beginner, the first time operator, so to speak, gets kind of weeded out just because they haven't been able to been given that opportunity. So I appreciate you alluding to the fact that, there are opportunities for people to come in and work with newer operators. And I find that I'd be interested to get your perspective on this, is sometimes the communication between a newer sponsor could be completely different from an operator, a more experienced operator, right? Because a newer experienced operator may have a defined business. They've already made, they already have success. And so sometimes accessibility may be a little bit more different than versus if you have a newer operator. Would you agree? Would you have any feedback to that?
Yeah, absolutely. You have to, not only is it a fun topic, but make sure I don't get too excited and go long-winded here, Cody. I'll just say that, like, style and preferences matter too. Yes, this is we're talking about money, we're talking about finances, we're talking about investing. So clearly that's the name of the game here. That said, you're going to see 100 plus just today. Like, go out and find 100 plus different syndicated apartment deals out there, right? And so, like, really, how do you parse through all that noise? You have to figure out who works with you, who communicates with you, who actually, like, frankly, aligns with you across all these different facets in a way that you want to go and commit yourself into, because you're going to be working with these folks. Even if you're passive, you're going to be communicated to, you're going to get K1 forms, the tax forms back from them, like, you're going to be getting all these different things. And so I would rather, in some cases, like some of the folks that we work with now, they don't have as many exits as some of the heavy hitting folks that are out there that have been doing this for 20, 30 years. I would absolutely continue to work with them any day of the week, because they operate with modern communication standards. And this is where I'm going to just shout out and say, if I see an AOL.com address hit my inbox, I delete that email. Full stop.
Awesome. Well, look, we had a couple questions rolling here, and I promised Nicole, Brian, I'll get to your question, but this one's right in segue into what we're discussing now, is from Andy. Spencer, what would you want to see with a brand new investor trying to do their first deal?
And just as a follow-up to clarify, make sure I answer it right. Are we talking on their first deal actively, like they want to go buy a property themselves and manage it?
Andy, you'll clarify that, Andy? Yes.
Cool. I would say first and foremost, just take stock of not only, I think it's the easy answer is make sure that you understand the core concepts and kind of like the what and the how, all that stuff that goes into getting a good education, meaning like you got the underwriting, a good foundation of underwriting is like a table stakes expectation. Like, you understand not just like how to go and say good return, bad return, but like, just do your best to try to dig in and nerd out, even if it's not second nature, to go and find a way to get curious. Because if you try to skip that step and you don't really like, I know this is like almost a personal development point here, guys, but like if you bypass the step of saying like, I don't really like that aspect of what I'm about to go do, it's going to come back and bite you. I think because it's going to rear its head because you didn't pay enough attention to it. And if you don't find a way to like light a fire and get curious about a specific aspect, like, and you got to start with like underwriting as a entry point, I think is important. As the next step, I would say, identify your deficits, like flat out, if there were things you noticed that you were not particularly interested in, and you may even try to be self-aware and figure out that you're not maybe that good at. There's different things I'm not that good at. And that's why I try to establish partnerships with people who are very good at some of these things, or you hire and work with vendors and you create some kind of team together to go and acquire the property that you want to acquire. So again, I don't necessarily know what size of asset or type that you're going for, Andy, but that would be a couple of things that come to mind first and foremost. There's times to rush, there's times to push. Making offers is one of those times. Beyond that, I would say there is not a rush to try to get to the point of making decisions about critical things like market selection, of strategy choice. I think a lot of folks rush straight into, and I did this. I mean, you heard this earlier. I rushed straight in to go buy a local property because I thought that was the right move. This is a few years ago now, but it ended up being that was not the right fit, and I spent too much money, and I didn't understand cash flow investing yet for our own goal setting purposes. Again, that was a couple twists and turns, but I would just say I'm happy to connect more offline if you want me to give a more kind of tailored answer to that one, Andy, but I appreciate it.
Perfect. All right, Spencer, let's see here. What are the pros and cons for individual property syndication deals versus fund deals with A and B share funds?
Ooh, that is a timely, educated question. That's a weekly, regular conversation for me right now. Simply said, single asset deals, broader spectrum of potential outcomes, which could be very good. It means if it hits a home run, project goes great, everyone in that project will be very happy as an LP. If project goes bad and you're wanting cash flow, you will not be happy as an LP because you'll probably not get distributions as an LP and you might not get your money back as an LP. So that was single asset. On the fund, it has baked in diversification. So there's pros and cons for both of these. On the fund, that means that if, let's say, there's 5 properties in that fund, they're all going to go into one pool together. And if that goes very well, that means that if one of those slams it out of the park, just completely amazing outcome, it'll be somewhat muted because it's going into the fund with the rest of the properties, right? So as an LP, then you're going to not necessarily see that same high-end spectrum outcome that you would in the single asset one. On the downside, though, you have a little bit more protection baked in because in either case, of course, you're dealing with syndications, which is like technically like, this is all high risk investing, right? Private placements is. But on the fund side, you do have some protection because you have multiple other properties that can help protect it. So if one of those goes down, and by down, what I mean is, let's say occupancy drops from 90+% on one particular apartment building down to 50% below the break-even threshold, so much so that it cannot produce operational profit and cash flow for the investors to get paid out. Single asset deal, you might not see distributions for a while, if at all. Fund, you probably still will, assuming that their properties are still performing.
We're seeing a lot more fund and fund-to-fund structures, I believe, coming in through the private equity space, right, Spencer? I think some people even would argue that that's kind of probably the way the industry is moving as far as raising private equity is more of the fund structures. I don't know if you have any feedback or comments to that, but.
Yeah, I mean, I think you're right, just about the observation, on more funds these days. I think sometimes what is lost in the broader narrative, or it just, unless you dig deeper, is like why is that? Besides the fact that like why are funds attractive? And I don't mean for the passive investor, I mean for the sponsor, for the GP. It makes them competitive because they can approach and say, we have the capital, it's ready to go, we can execute. So if you're making offers in a very competitive market, that is 2021 right now, absolutely, like talk about the most competitive market of all time, right? It is advantageous to have the capital ready. Of course, then it is a little bit more nebulous. So it could be harder for a sponsor to be able to go and, raise funds in a fund, because it's confusing relative to a single asset deal. At first you have to have these really important discussions with whoever you're working with, just on that really great question we just walked through here, Cody, about single asset versus funds. So I would just say that the competitive edge of a fund from a sponsor side is awesome, but it is, they're also putting a lot of hard work in to create it, put out the fee, the expenses needed to go and form it, working with the proper attorneys and doing everything legally and appropriately and compliantly. That's a lot of overhead. It's a lot of admin. They're also signing themselves up for some more reporting stuff they have to do. All this, there's always pros and cons, but I would just say that in a competitive market, those are some of the reasons why you'd see some sponsors doing more funds.
Gotcha. Awesome. All right. Since Michael asks, what are some fees that are acceptable and fees that are ones you want to look out for? I'm assuming from the position of a passive investor as well.
Oh, I mean, one of the ones that you're always going to want to just have a general sense of is, acquisition fee, asset management fee, property management fee. And when I say property management fee, like, we probably don't want to go too far down the fee rabbit hole because it ends up creating like a can of worms, but I'll just say that like it's good to know the distinction on if there is a property management firm that is third party, like how much is being paid, what are they actually doing, like are they competent, do they have a track record, all that stuff. So it's good to have an awareness of those things. And of course, if there are other fees that are not normal, that is the most important thing to notice. There shouldn't be any, but then again, it's not binary. I'm not here to preach at people about, like, for example, on like, certain fund structures, you're going to see fund related administrative fees typically, and that is normal. But it just depends on the type of deal, single asset fund, or otherwise.
Gotcha. And really, this is a question that kind of piggybacks right off that, referring to waterfalls and the way the equity splits are. So what is your preferred way that the GP and LP split profits, and why? Again, for example, preferred returns, waterfalls and such.
That is one where I get to go and just give the blanket. I can't answer that live because I'm a registered representative of FINRA. I'm happy to answer that question offline if someone would like to reach out and ask.
All right, Todd, you got to reach out to Spencer there directly. So, all right, Spence. So let's say, for a lot of people, we hear about getting started. Passive investing is a great way to get started in the multifamily space if you're wanting to learn how to be active, right? It's a great way to partner with people and learn firsthand from experienced operators how they run the business, how they operate business, how they communicate with passive investors. Great way to get started. Nicole would like to know, how many deals do you have to make as a passive investor before transitioning to that GP side? Is there a recommended number of deals as a limited partner before you kind of scale up and start building your own team?
Oof. I sure wish that there was a simple answer I can give to that one. It's an outstanding question, though. I mean, I think it depends on how hard that you like. I think like anything, not to get preachy, this is like professional development, Spencer, coming out. Most of the best learning in life comes from taking action and figuring out your limits, right? And then skinning your knees on the learning. I think some LPs tend to get let down by how much that they are not getting out of LP investing from a learning perspective, unless they already know going in, they're going to get like maybe monthly emails, quarterly emails, and perhaps a profit and loss statement and rent roll, maybe on a quarterly basis. The vast majority of people don't really learn from that passively unless they are committed to a learning plan, and they are absolutely just to be real with you guys. I mean, I read 24 books and listened to over 400 podcasts while working a day job at a real estate company by day. And so I was burning the midnight oil, working really hard. And this isn't a brag point. It's kind of, I mean, you saw the picture of me at the beginning of the presentation. I was looking haggard. And Cody said I've aged like 10 years in the last 3. So we all know how that works. I'm not prescribing that playbook because it was pretty rough. But I would just say that it is a good first learning experience to understand and see through the lens of the LPs that you will eventually potentially work with. But don't mistake it for the benefits of coaching. I do think coaching programs play a role there if you want to accelerate. I don't have my own, by the way. This is not a pitch. I can't pitch anything. I don't have a coaching program. So I have used 4 personally, paid for 4 real estate coaching programs. I think that there are great ones. They are specialized depending on, some do everything. some do something very narrow, and there's really excellent ones. There's also a lot of very new ones. And so you got to make sure that, just not to say the new ones are bad, they're not, but understand what you're signing up for, and before you invest the money in that as well. So short answer would be, to wrap it in a bow, LP investing, great first start, but I wouldn't look at it as like a necessary step to go get active. I think if you have the capital, think about how you would, want to allocate that best towards your learning journey. And maybe that learning journey coincides with also, investing in something.
So beautiful. All right, Spence, I think this one's coming more from probably after you've transitioned to more of a general partner. Ian says, awesome information, by the way. When stabilizing a new acquisition, what steps do you take and in what order?
I mean, that's probably its own dedicated webinar, right? Yeah, I mean, Cody's probably more qualified to answer that one. But I would say that, first and foremost, you're going to go in and install the new property management company. If you're working with a third-party property management company, taking over ownership, it's whoever's going to grab the reins needs to grab them swiftly and effectively, and have a plan. Kind of coming back to the whole, the slide that we covered earlier about a repeatable business process. If it's your first time doing it, you're going to want to probably talk to other people who have done it. I'm not going to say you think you should. You should go talk to other people who have done it. You should see what their playbooks have been that are effective, and then get ready to deploy that playbook effectively to take over management and have the right pieces in place first. If it's depending on the property, like if it's going to be rehab driven, if you're forcing appreciation, which is awesome, then you need to have some kind of construction capability, whether that's your own, that you have your own team, or you're going to find a team. It's a hell of a time to find general contractors right now, and I don't think anyone likes the price of lumber right now. So it depends on the size of property, type of property. That is also why, as mentioned earlier, I watch YouTube to fix things in my house, and I partner with people who are really good at asset management.
I love that. Spence, I got a question. Who do you feel is best suited to be a passive investor? I know you kind of alluded to it earlier in the presentation about trying to figure out kind of essentially what your investing thesis is, right? And who do you think makes the right passive investor?
Yeah, gosh. I've wrestled with this one a lot, actually, and I think it's a really it's a timely question, particularly given the state of the market for so many wonderful reasons we probably won't have the time to go into here. But I will say, they have to be well-heeled, and I mean that in a financial sense. I think in the market right now, there is an abundance of exuberance, and I think exuberance makes people jump into things they don't understand. And I think that right now is a wonderful time for people to pause and consider before they jump into a passive investment, unless they are prepared to lose their entire capital amount. I'm sorry to be a downer, folks. I know we're on Facebook Live. I think it's a very important point. And so you asked the question, I had to give the answer. I think that folks should be getting into an illiquid investment if they are prepared to lose the entire amount. Probably won't happen if the job is done right and if they're working with great people.
Powerful. I like it.
Yeah. Sorry to be so binary about it. It's just, I think it's more timely than ever right now in the market. I also think that people who make strong, true accredited income, accredited qualification are probably best. Should sophisticated investors play? Absolutely, if they know exactly what they're getting into and they are prepared to actually to not have to worry about their home mortgage, to not have to worry about the food on their table, putting their kids into school, buying what they need to take care of their families. So that's the most responsible advice I can give on that front.
Yeah, it's great advice, and I really appreciate that. And I think that we need more upfront truth telling, right? When we talk about different things, because it's very easy to go to different networking events and hear the hoorah and hear the glamour from the gurus, quote unquote. But, like you said, these are very illiquid investments. They're very, you're talking about 50, 75, $100,000 investments, and you're talking about 5 to 7, sometimes even 10-year holds. And so they're very easy to get in. They're very, very difficult to get out, if at all. So,
but now that we scooped it down and I took all your energy out of the room, I'll just say, this is what I do full time. And there's a reason for that. I believe in the asset classes that we're in. I believe in multifamily deeply. I literally pivoted my entire professional career around it, so much so that, I love what I do every day, And so all that to say, I just want to make sure the passive LPs that are out there hear that message loud and clear. It's absolutely awesome to participate in this asset class, but do it with eyes wide open.
Yeah, absolutely. And guys, again, please feel free to continue to drop your questions in the chat box, or feel free to come on the screen. I'm just going to blabber away. I could talk to Spencer all day long, but Spence, what about the expectations as a passive investor in today's marketplace? I mean, 5 years ago, I think return expectations were much different than what they are today, or at least we're seeing a change in at least yield from where we're at in this market cycle. Any insights as to far what you're seeing from a passive side as far as what those expectations should be?
That one I would love to talk shop upon, but I just can't do it here, unfortunately. Sorry to pull the card again. I can't talk about returns. So
gotcha.
Yeah, sorry guys.
Dang FINRA. That's okay. No, hey, here's a great question. Okay, this is from Glenn. Do you want to speak about how you vet a passive investor?
Ooh, I like it.
That's a good one.
That's a good one. I think fit and expectations in terms of, style, you got to just speak, you have to acknowledge style. I think that's very responsible. Like, I'm a guy who, I truly do strive to be within this very niche space that we are all playing in. I strive to be incredibly transparent and conservative in terms of my expectation setting. And so sometimes that means that I qualify a lot, but sometimes it means I give disclaimers, as you guys have heard now in 3 different questions that I've had to punt on. Like it's not something that like I inherently take joy in. It's something I think is like the right thing to do. And so some people, you can go out and find stuff that is much more flamboyant than me. And I think that if that's what you want, which is, this is a zero judgments perspective from me here. I'm just saying, if that's what you want, then that's probably a better fit, man. Because I'm here to just try to deliver the facts and do that in a responsible, consistent manner. So not everyone wants to play that way. Not everyone is I am wearing the collared shirt right now, even though it's hiding some of the tattoos. And so, that's how we strive to operate and how I strive to operate. But I think fit, style, communication. Some people go very, very detailed on their quant, meaning like just their quantitative and their numbers when they're doing quarterly, monthly reporting. So understanding what an LP is looking for there. Active, this is probably a very niche comment. Active investors, or I should say aspiring active who are starting passive, often have significantly higher expectations as to what they want communication and involvement wise. So back to the prior question, which is a really good one. Like how many, I think it was Nicole who asked a really smart question about how many LP investments before going into a GP role, making a switch. If you're an LP investor and I'm talking to you for the very first time, and it sounds like you want to eventually go down the active path, we'll probably just have like a super honest, like casual conversation about, like what are your expectations? Because I don't want to miss them. I don't want you to feel like you're uninvolved. I don't want you to feel like you're just getting the email and you're just sitting there going, well, what do I do now? It's important for folks to just reflect on that on both sides and make sure that the fit is there.
Spence, if I can, I'll flip that comment to just slightly from a passive investor. When you're vetting a sponsor, you really want to be careful in how that's translated. You don't want a sponsor who's really pushing you and trying to make a sale, quote unquote, right? You want them to be transparent and make sure that they are a good fit for you as well and what they're offering. Because if they're going and they're pushing you and they're really just hounding you to make that investment, to me, that would be a red flag. Would you agree?
Absolutely. And I think there's even times where I think early on in the journey for me, I'm a guy who comes from like an operations background. Like there was some sales leadership, some operations leadership mixed in throughout my journey in tech. So I'm a process dude, and process dudes sometimes forget that just because you're trying to hit the timeline and send the email at the right moment, someone might perceive that as pressure, despite the fact that wasn't the intent. So we're talking about wasn't even intended pressure. It was, but someone could feel that way. And so we've had to learn that. I mean, I've had to learn that and adjust for that and try to do my absolute best to leave breathing room for people to be able to just know, like, hey, you do you, and you do it on your timetable. Like this is truly intended for it to be a vehicle for you to hopefully not only feel engaged, but relax throughout the process. And so really thoughtful way to switch this to flip the script a little bit on that, Cody. I think that the more relaxed, think of it as a physical lean back posture that a sponsor can hopefully take without taking the air out of the room. Obviously, you're trying to build excitement around a project, of course, but like it's about letting people run their playbook and being an educational source. There should be, I truly believe that there should not be I'm going to get, a lot of flack from some people out there probably for saying this. It's not about selling. It's about educating. And then that's it.
Yeah, absolutely. Absolutely. Well, guys, I know, Spencer, that's all the questions I have for you, man. I know I could talk to you all night, man. Really always appreciate your wisdom. So appreciate that. And here we go. Andy, do you have a preference on how long they hold an asset? 3 to 5 years, 5 to 7, or 7 to 10?
Oh, sorry, Andy, I can't give a quick answer on that because I feel like it's just, it depends on the goal. It's like you have the asset class and then you have the strategy, and, depending on how those things align, with my hand claws, completely non-scientific hand. It's a really good question, genuinely, Andy, because I think it throws people for a loop when they see the hold period sometimes. Like a 3-year development deal that has no distributions along the way expected. Some people want that, but those are also the same people who have so much capital in their war chest already that they don't need the money in the meantime. Someone who is 5 to 7 years on a hold period, and they're doing that because they like the notion of passive income and they're a cash flow investor, that person absolutely cares about the duration because they're actually not wanting to sell yet. Like they actually want to hang on because they're actually planning on getting some distributions and the passive income from that investment. So it depends on what's the objective, and so the further along someone is in the financial journey, typically, like you're going to see someone wanting to do, I'm speaking in broad terms here, but like they'll want to do something that is a quick return and return on, they could flip their capital back and get something promising out of that quicker. Whereas other folks, I would say the other folks probably should be looking for something that is more predictable and lower risk over a longer hold period.
Yeah. All right, Nicole ask, if you're looking for strong cash flow, what hold period and asset type would you look for? I think you probably kind of alluded to that just a second ago.
Yeah, but now we're getting into that territory. I get nervous in, so I probably can't answer that one live.
No worries, man. No worries. All right. Well, Lynette, Jarvis, you have anything for Mr. Spencer?
These are wonderful questions, guys.
Not at the moment. I think Spencer kind of answered all my questions as well.
Awesome. Awesome. Well, guys, any other questions for Spencer? Awesome. Well, Spencer, listen, man, this has been always a great conversation. Always appreciate your wisdom and knowledge, and really appreciate you spending time with us this evening. Before we go, if you wouldn't mind telling our audience how they can maybe get connected with you or learn more about Madison Investing.
Yeah, and thank you guys. Honestly, this is a blast. The questions you guys were firing out were like really, really good questions. So thank you for that. I'm sorry if I can't answer some of them live, just because of the compliance stuff. So yeah, MadisonInvesting.com is our website. But if you ever want to connect, I after taking a brief hiatus and little digital detox, I'm back on LinkedIn and active on there now again. So LinkedIn is a good place to connect with me. I don't spend, this is the most time that I've spent on Facebook in a while. I'm more of a LinkedIn guy, but I'm happy to spend it with Cody and with you guys. So LinkedIn is my jam. Spencer at MadisonInvesting.com is my email.
Awesome. Spencer, thank you so much again for your time, man. Really appreciate it. Always a pleasure to see you, and glad you're back on the digital front, man, and wish you nothing but continued success. Guys, if you haven't already, please make sure to check out the South Texas Multifamily More Facebook group so you can stay up to date on future events. We have our next live meetup that's here in Houston. And if I'm not that's coming up on June 10th, excuse me. And if I'm not mistaken, our co-host, Mr. Nick Amaluxon, is kicking off his Austin meetup back live in person again here very, very soon. So stay tuned to that. Also, a lot of great networking and educational content that comes through the Facebook page. So if you haven't done so already, please make sure to jump over there. And it's about almost 8:30 now. So we're going to go ahead and end it for the evening, but great to see you all. Appreciate you all staying with us tonight. And on behalf of Abels, Lynette, Jarvis, and Nick, we hope to see you next time. Thank you, guys.
Thanks, Cody.
Thanks, Spencer.
Thanks, Cody. Thanks, guys.